Ever wondered why choosing the right broker can make or break your trading? Not all brokers are created equal, and picking the wrong one can cost you before you even place a trade.
Welcome back, traders. After exploring the structure of the Forex market, our journey now takes us to London, the world's largest Forex trading hub. Here, we'll see how traders connect to the global currency market and why choosing the right gateway, your broker, can make all the difference in your trading journey. Every trader needs a broker to access the Forex market. So in this lesson, we'll look at the most common methods and the industry terminology you'll encounter when opening a Forex trading account. Brokers use different models to handle client orders. And sometimes even the same broker may use more than one depending on the situation. The first model is called agency execution, or what's often known as the A book. In this setup, the broker acts as a true middleman. Your orders are passed directly into the wider market, where they're filled by liquidity providers like banks or hedge funds. The key point here, with A book execution, the broker isn't taking the opposite side of your trade. Their role is simply to connect you to the market. In the A book model, the broker is just the middleman. Your orders go straight to the market and are filled by banks or liquidity providers. Brokers often use ECNs or STP systems. Think of them like a global highway. Your buy order could be matched with the best sell order anywhere on the network, even from another retail trader if the price is right.
Before we dive in further, be sure to hit subscribe so you can keep up with each lesson. For the best experience, try watching on a bigger screen. And don't forget, grab your free quick start guide at mmufreeguide.com and start your trading journal today.
Thank you, Michelle. Now, unlike the open ECN highway, STP, straight through processing, routes your orders through specific channels your broker has agreements with. It's still direct to the market, but on a more limited closed network. Think of it like ordering food through an app that only works with certain restaurants. Your order still goes straight through, but only to those partners, not every eatery in town. Under the agency or A-book model, brokers earn in two main ways: by charging a small commission on each trade, or by adding a tiny markup to the spread. Since your orders are passed straight to the market, the broker gets paid whether you win or lose. It's just like a toll booth on a highway. Every car that passes pays a small fee, no matter where it's going. Now let's look at the B book, also called the principal or market maker model. Unlike the A book, where trades go to liquidity providers, in the B book, the broker keeps your trade in-house and becomes your direct counterparty. Now let's look at the B book in action, where the broker acts as a market maker, taking the other side of your trade. Think of it like a casino. It doesn't connect players to each other. It plays against everyone directly. In the same way, a B book broker becomes your trading counterparty. Knowledge check. Which three boxes describe an A book broker? You've got 10 seconds. Pause if you need a moment. Correct answers: charges commissions, offers variable market spreads, and routes orders straight to liquidity providers. A-book brokers pass your trades to the market, so they don't win when you lose. Most brokers today use a hybrid approach, combining both models depending on the situation. They might use the B-book for smaller trades, but switch to the A-book model for larger positions or orders from very active traders. It all comes down to trade size, client profile, and market conditions. One concept that differs between A-book and B-book execution is slippage. This happens when the market moves between the time you place your order and the time it's filled. The difference between your expected price and the actual price is called slippage. We've talked about this before, so it shouldn't be a new term for you. But keep it in mind whenever you're trading fast-moving markets. Slippage is usually small during normal market conditions, but when major news breaks or volatility spikes, prices can change in just milliseconds between placing your order and execution. That's when slippage becomes most noticeable, and why fast markets demand extra caution. Knowledge check. A trader places a market order to buy the euro against the US dollar just as a major economic report is released. With which execution model would they most likely experience significant slippage? Will it be A, principal execution, B book, or B, agency execution, O book? You have 10 seconds to think through your answer. The correct answer is B, agency execution, A book. During major news, prices can move rapidly, and because A book orders go straight to the market, even the few milliseconds it takes to reach execution can cause slippage. So, does this mean B book execution is better during news events? Not necessarily. While it may result in less slippage, brokers using this model often compensate by widening spreads or even restricting trading during volatile periods. Each execution model comes with its own set of trade-offs. Understanding how your broker works helps you make better trading decisions and choose the right broker for your needs. Let's recap. 1. Brokers use different execution models. Agency execution, or A book, routes your orders directly to the market. Principal execution, or B book, means the broker acts as your counterparty. 2. Slippage occurs when your order executes at a different price than requested. 3. A book brokers typically show more slippage during major news events. And 4. B book brokers may show less slippage, but often at the cost of wider spreads. Keep these trade-offs in mind when evaluating brokers. All right, fantastic work. Another lesson completed. You've built a strong foundation on how the Forex market operates, who the key players are, and how brokers execute trades. Before moving forward, take a moment to check your understanding, and then we'll continue exploring the next key concepts in your trading journey. See you in the next lesson.
Great job finishing today's lesson. If you found this helpful, be sure to subscribe so you don't miss the next one. And don't forget, download your free quick start guide at mmufreeguide.com and start building your trading journal today. We'll see you in the next lesson.